fundsupermart.com.
What is your view on the QE3 and US elections, and how are they likely to impact the markets? And with that, how will you position the portfolio going forward?
The focus for us for the US economy is to consider what can change investors' expectations for the growth outlook and the inflation outlook. The outlook for the fiscal policy in the US is critical in this regard. The concerns that market participants have over the fiscal cliff, which is due to be enacted at the 1st of January next year, is as a result of the automatic cuts that come into discretionary spending. Currently, the assumptions are that there will be a 3% hit to GDP in the US next year if no negotiations can take place to ease that burden. However, it's likely that there will be some compromise between the two parties in the US to allow for a slightly easier burden on the growth outlook. Our assumptions are that the hit to GDP will be about 1% away from the normal run rate. This is still a low growth environment, but a positive growth environment. This will allow for positive return to investors from government bonds, from corporate bonds, and markets shouldn't be too surprised by that sort of outcome. However, if we get a surprise in either direction on the fiscal policy, either a more stimulative fiscal policy or a more negative fiscal policy, that will clearly be a concern for bond investors and for stock investors alike. On the inflation side, the outlook that we have is one where inflation is not a concern for investors. The leading indicator that we find most appropriate for inflation in any market is the outlook for wage inflation. And wage inflation in the US on an aggregate basis is running at the lowest level in 30 years. This is not the sort of environment for inflation risk to the upside. It may be a risk in many future years to come, but for the near term and for the investable future, we think that the inflation risks are to the downside.
How do you manage currency risks in the portfolio?
The fund exposes investors to the US dollar. The fund is 100% US dollar based, and even if we have positions outside of the US dollar bond market, we make sure that we fully hedge the currency such that investors are only exposed to the US dollar. There may be some occasional and rare opportunities where we find a more attractive opportunity to buy a small position in a currency which we have a high conviction will outperform the US dollar, but this will be a tactical trade and this will be on a risk-controlled basis. The focus of the fund is to generate income and capital gains from the portfolio of corporate bonds and government bonds and a variety of other sort of fixed income asset classes, and currency is a low source of value add and also a very low source of risk for fund investors.
If, and it's a big if the equity markets return to normal next year, how will you position a portfolio?
The equity markets will be driven by a range of factors which I think will actually be relatively similar to the drivers of the bond market over the next few months, and that will be the ongoing Eurozone crisis and the issues around that, as well as the fiscal outlook in the US and whether there can be some compromise to adjust the amount of the GDP hit by the fiscal cliff. What we are also finding, which is of interest to equity investors, is that many companies are using the bond market and the historically low levels of interest rates to borrow money at cheap rates and to buy back shares and to increase dividend prospects. So that's clearly negative for bondholders on the corporate side, but positive for equity investors. We manage against these risks. We want to avoid companies that are too shareholder friendly. We prefer companies that are more bondholder friendly in the sense that they are risk averse and have a strategy to delever their balance sheets. So that's one way in which we mitigate the risk on the equity side. Whether equity markets go up or down will be a function of the two earlier risk factors that I mentioned, as well as the general global growth outlook in emerging markets and in developed markets.